Stock market update, August 7th, 10:20 a.m. Eastern Standard. Let's take a look at the charts and see what we're looking at today. So I talked yesterday about the markets, and I talked about how we were having a very weak amount of buying for what we would want to see for a recovery. And actually, as soon as I finished that video, the market rallied. And interestingly enough, the market actually sold off quite a bit going into the close. There were some earnings. SMCI got crushed. Airbnb got crushed. There were some key earnings that did not go too well, but the market is showing resilience and actually showing a pretty decent recovery rally right now. So still kind of a chop fest, and I don't necessarily trust that this is just all up from here. We have seen days previously where it's, one day massively down and 3 days up. So we're just going to let the dust settle and see how things play out. However, let's take a look at what we're looking at here. As far as futures, silver's down. Gold is trending up. We're looking at a potential position to go long on this gap fill, but we've got quite a ways to go down before we can actually get in on this position. I really don't like gold here. It's really just shopping around. It's like, are we bullish because we're going into rate cuts and there's kind of economic uncertainties, or are we bearish for various other reasons? Markets are resilient. Markets are going up. So gold is going down. Interest rates going down potentially weighs on gold. Like, there's just a lot of different things that factor into the price of gold. So we're kind of just sitting out there. Platinum going up a little bit. Palladium looks like we have missed this bottom so far. There's a bit of a V recovery. I'm still holding on to the opportunity to buy at these lower prices. I'm not going to chase the trade. 30-year Treasury is down pretty substantially here. Wheat, oats, just kind of sitting relatively neutral. Wheat down a little bit. Dollar's up slightly. Oil, we'll talk about crude in 1 second because this is one of our active positions, as well as we're looking at gasoline. Nat gas is up. Bitcoin is kind of chopping around a little bit here. So if we go to foreign exchange or currencies, we're looking at Australian dollar showing a bit of a recovery rally and strength here. We're out of that position, made an excellent profit. British pound slightly up on the day. Looks like it's still breaking down pretty substantially. I would like to see it close below this trend line that dates back to about October 2022. I think a critical close below that means we've got quite a ways to go lower here, probably to this first trend line, through this support level, to potentially the swing lows here. So I think still a lot of down opportunity for the pound. Canadian dollar, reading there was some weaker economic data here that came out in Canada, and Canadian dollar is still up. So this is looking like it was a bear trap. We're in on some positions. We're trying to actually add to our positions, but this is looking good. Swiss franc, not looking so good. Bit of a sell-off as the market rallies, so don't know how the positioning is going to look. We'll probably look at getting out of this trade in the next week or two. Yen still showing a bit of a dip. And New Zealand dollar is actually showing some strong strength here, but I don't think we're going to get in on an entry on that one. And then just quickly, if we jump to the charts, markets up, NASDAQ up 1.5%, similar for S&P. Russell's up 1%, Dow's up 1%. Things are looking pretty good here as far as the recovery. But again, let's see how the close plays out. We had a good close yesterday. We've got a bit of a V-shaped recovery, but we're coming up to some key resistance here, at least on the S&P and the NASDAQ. So is this going to be a sell the rally scenario, or is it a buy the dip? I don't know. Let's see how it plays out. Coffee having a nice rally today, but just not something we're going to be able to get into at these prices. Getting closer to that top channel of resistance. The VIX really coming off the tops here. Ethereum's down another 3%. That's looking like a bear flag. That's not really a good pattern or indication that we want to see. And similar for Bitcoin, we're actually looking to get in on a Bitcoin position, really a small starter position here if we get a sell-off back down to about 54,000. So let's talk about the trades we're in. Trades we're in right now are crude oil, which has had a nice 2% pop today. We are well in profit on this trade. We talked about, I believe, yesterday. We've got this bottom wick that was from the major sell-off day the other day. That is our stop level, and we are coming up against some resistance right now if we can break through that, we've got quite a ways to go for some upside movement. And that reasoning behind getting in that trade is gasoline and crude oil track very similarly. And gasoline is a very crowded short side position. So a lot of speculators are expecting gasoline to go down. And while all the markets were down, gasoline happened to be up the other day. So we decided to enter in on that position at a very good price. And now we're starting to see a bit of a bounce, which is good. Gasoline contracts just trade a little bit too large volume or size for me for where I would like to put my stop. I don't want to risk that much on one trade. So we did crude oil, which tracks very similarly instead. And crude oil actually showing a bit more strength than gasoline, which is interesting. Other positions we are in are British pound short, which is still going really well. We actually shorted it at the exact top wick of this candle here, which was just, a bit of luck, to be honest. Canadian dollar, we're in on this bottom, not the wick, but the bottom of this, this resistance or support level. And then Swiss franc, we're in on from, way before the beginning of this rally here, which is a nice profit, but starting to pull back a bit. So what are we looking at? We are looking at potential trade in palladium if we can get on the long side, and Bitcoin. I think those are really the only two positions that I see that are decently set up right now for us to enter on the long side. We are kind of just hiding and watching to see how the dust settles with the market. And I want to walk through some stock opportunities as well, because there are some things that are looking interesting after these corrections. For instance, Lyft, bad earnings, stock getting crushed. Big red candle here from the earnings, but the earnings weren't that bad. Earnings not that bad, and yet the stock is down 12%. So we've actually added a pretty decent starter position here on Lyft. Other opportunities that I'm seeing, Tesla's just chopping around here. We're in on a pretty large position there from way back in 2019, 2020. Intel, I don't know where the dust settles there, but there's a big gap to fill potentially from $20 up to $29. So don't know when we get in on that. Lululemon, it's also a nice one. We're getting in and looking to add to the position here. We're already in on some positions there. I like the price there. Other positions we're looking at, Micron, starting to look like it's at an interesting price. AMD, I liked the day the market everything was red, AMD was up. That is really interesting to me. It closed up. Other positions that I like and am in. So SMCI here, just look at how bad this looks. There was a top wick and then a massive sell-off after earnings yesterday. TLT, the 20-year treasury bonds selling off pretty good bit there. I think that's going to go up as we go into this rate cut season. And then other position I want to highlight is Five Below, which is a dollar store type chain. This thing I liked at $100, so I like it even more at $60, but we're not going to add too much more to this position. I like kind of where it's at. It's a longer term play, so we'll see how that kind of plays out. I still like Alibaba and some of these Chinese stocks, and I actually did add a starter position on EWJ, which is an index fund that tracks Japan. So the Japan ETF, I actually got in around 62.50, and then it's gapped up on the day as the Nikkei has rallied back. Japan actually looking pretty strong here, up 4%. So that's the positions we're looking at. SMCI I'd stay away from. TLT, I like having some bond exposure here as we move into rate cuts. I think that's a good trade, especially at these levels or lower. TSM's on our radar. PayPal, Baidu we're in. Coursera we're in. NVIDIA we stay away from. MGM we're kind of looking at. It's a pretty nice V recovery happening there. And Lyft we just added in on, as well as a position on Lululemon, and looking at Micron as well. So yeah, that's some of the ideas that we're looking at as far as specific stock picks. So hopefully this was helpful. We're going to let crude oil play out. Nice move to the upside. We're going to let pound keep selling off. We're going to let Swiss kind of play out and get the next commitment of traders to see if it makes sense to exit that position or not. And Canadian dollar here is just, man, that trade's looking good. It's in some nice profit. I would like to be in a larger position size, but we're not going to chase it. If we get a little bit of a pullback, which is highly possible, we will add to the position. This is just one. We might add actually 2 or 3 more, just to kind of get the average size trade that we would normally put on based on where the stop is. So for people that think, how do we trade? Like, what's the difference of trading and gambling? Well, first of all, you never want to risk your entire position on one trade. And there are some people out there that think, like, go big, pick the trades that you have a lot of high conviction for. You're almost certain that it's going to move in your direction. I would say the trades I'm the most certain in are usually the ones that are wrong. And it's the trades that you think, yeah, could work. Maybe it won't. Those are the ones that end up working. So it's really tough to know what trade is going to work. But the only thing that matters is bankroll management. We don't want to bank everything on one trade because we need to live to fight another day if we're wrong. So for me personally, I only ever risk 1% of my portfolio as of right now on any given position. And the most I would consider at this point in my trading career would be 2% on a trade. I don't feel comfortable risking more than 2% on any given trade. So what does that mean? So it means if we're entering on Canadian dollar and we are entering on the close of yesterday, we closed up 0.726. And we want to maybe have a stop down here. For whatever reason, let's say the stop is just going to be here. We are going to calculate 1% of our portfolio. How many positions do we need in order for that to be a 1% risk of our portfolio? So if we have a $100,000 portfolio, we're risking $1,000 on this trade. If I am wrong on this trade, I enter at 0.726 and it goes down to 0.719. How many positions can I hold? So that would equal $1,000. And that is how we size trades. And then for profit targets, we're usually looking at somewhere from minimum, I would say 3x upside. So 3x in terms of if I risk 1,000, if I'm right, I'm going to earn 3,000. Now, do I exit as soon as it hits 3,000? The answer is no. I exit based on the charting patterns that I'm looking at. Are we hitting key resistance and then reversing? I look at commitment of traders. Are we no longer in a compelling competitive advantage because the speculators are now neutral? They're no longer heavily stacked in one direction. Canadian dollar is a perfect example of this. Canadian dollar has had so many speculators selling this thing longer and longer and longer to the point that it's just down at these swing lows. I mean, it hasn't been this low since 2022. And now we're getting a pop here. And the reason being, we have so many people that are selling this thing lower and lower that eventually you're going to have some buyers come in. Eventually, they can't go any lower because there's nobody else to sell. And you get a short squeeze. And these are the opportunities that we trade for. These are the opportunities where it can't go lower. It only has room to go up. And timing that can be really difficult. But when you get it right, you're looking at a 3, 4, 5, 8x return sometimes versus your risk. So risk 1,000, maybe you're winning 7 or 8,000 on that trade. So that's how we size it. And we have to have an edge, right? And the edge that we're using is not just these chart patterns of drawing out charts, because anybody can do that. There's no real edge here to just drawing chart patterns. It's the data and the market intelligence, the commitment of traders, looking at how positions are stacked and going with the commercial hedgers when it makes sense to enter those positions. So finding positions that are heavily, heavily favored to go in one direction, and they've gone in that direction for a long time, and then finding the opportunity where that direction starts to reverse because there's not anybody else to sell or anybody else to buy, and switching direction. The British pound has been a really great example of this. Everyone was pushing the pound up here from, call it April of this year up until mid-July. Every speculator was long in this position. And then we got this top wick. And then what happened? We have all this red selling pressure. There's nobody else left to buy. And then there's more good news that comes out on the pound or on the UK, and the price goes down. Well, that's a pretty big indication of exhaustion, an exhaustion pattern, and a reversal. So that's how we trade. That is the difference between trading and gambling. We are looking for the data and the market intelligence that tells us there's a competitive advantage here, and we're still going to be wrong. 40%, 60% of the time. We're only going to be right maybe 40% of the time. But when we're right, we're looking at 3x returns, 4x, 6x, versus when we're wrong, we lose 1x. So that's just a basic expected value equation. Expected value, if I have 40% of my trades are right, but I win 3,000, and I have, let's just pull a calculator up here. If I have 40% of my trades that are right and I win 3,000, I've got $1,200 for the winners, and then 60% I lose 1,000. Let's see if we can get this thing to work. I actually should just do it on Google. I don't normally use that calculator. Let's do Google. All right, we have 60% of our trades make or lose $1,000, and then 40% of our trades make 3x, 3,000. We have a $600 expected value for every trade, right? You can kind of play around with this. You can say, well, we're only going to win 35% of the time. We're going to lose 65% of the time, but we're still a net positive here. So that's the difference with gambling. I mean, we have a competitive advantage if we know that we're going to be right. 4 out of every 10 times, we're wrong 6 out of 10 times. But when we're right, we're making 3x. This is a positive value. If I do 50 trades a year and every trade has an expected value of $600, we're making $30,000 here. This is just simple math that we're doing. So, we look for market intelligence, competitive advantages, and then bankroll management is everything. Stay alive to be able to keep trading, and that's how we profit. So that is trading in a nutshell. And we'll talk again tomorrow, and we'll look at how the trades are unfolding. Thanks a lot.